now that we got that taken care of, so here's my email. If you do have any questions today, I'll just rehash things a little bit. We'll be going through the corn and hay situation, looking at the cattle cycle and the supply outlook. I'll talk a little bit about the economy and demand expectations here moving forward. And then Matt will finish us up with the cattle market outlook and the calf and female market discussion. Just starting high level as far as corn goes, the final production report for 2023 it did have a few minor changes to us as far as a decrease in acreage and an increase in total yield. But all in all, when it finishes out, 23 was a record for both yield and production. Even with those decreased harvested acres, we were able to offset that and have a pretty comfortable stocks to use situation. They're estimated at 14.8%. As we look forward into 2024, we do still expect a solid year of corn production and a solid stocks to use number outlook as we head forward. And we've seen prices respond accordingly. The corn market has been trending lower really through the balance of 2023, really since the summer of 2022, where we put in that high in the futures market. And as we've been able to get production kind of brought back and see stocks to use increase to a little more palatable level, we've seen that market take on a more defensive type of posture. Now, we probably aren't going to see a substantial amount of risk lower here from where the market is as far as corn prices at that 450 type of level. It does look like we're starting to see some forms of support, and we would expect more of a range-bound type of market between 4 to 4.25 on the low end for 2024, with topside potential towards 550 or even $6. We'll see as we go through the production year what we're seeing from a drought impact standpoint, and any challenges that could lead to some volatility there. But ultimately, the corn picture does look fairly friendly. Now, this is going to allow for cheaper cost of gains on the fed cattle sector side, and we will likely have the incentive to put a little bit more weight on cattle, where our cost of gains are probably somewhere between that $1.10 to $1.30 area. And then we look at where the fed cattle market is today, closer to 170, 175. There's certainly incentive there to add weight to cattle, especially as we come through the spring and with this weather impact that we've seen over the last couple of weeks, certainly impacting carcass weights. So we could certainly see pretty big weights even when we get into the summer time frame, but especially when we get into the second half of the year, just because that margin is available with this corn price being such a wide spread relative to where the value is on a per pound basis. Moving on to the hay side, we did make a step forward as far as production and prices go in 2023. Do expect to continue to see some headway, but we are still at a fairly tight stocks level as far as our production goes. 2023 is still at the lower end of the last 20 years, and do expect things to be a little better into 24. But likely need to keep an eye out for regional differences here. We are in that El Nino pattern here for this spring, but it is looking like we'll shift back towards La Nina. We'll talk a little bit more about that later in the presentation, but can certainly lead to some challenges on the weather side and likely see some regional differences. But still, if we do just take a look and use the correlation between spot corn futures and the all hay price on a national basis, these two do generally tend to trend together. Sometimes corn or hay can stay a little bit more elevated for a little bit longer, but we're seeing that take effect. Now, we don't think that there's necessarily substantial risk lower as far as corn goes, but should still have some room for hay prices to move lower as we come into 2024. Moving into where we are from a cyclical standpoint, we've been in this liquidation phase of the cow inventory really since 2022, where our beef cow herd has faced challenges from a drought perspective. Up until here recently, prices haven't necessarily supported an expansionary trend either. And so even as we've come through 2023 and we have seen the liquidation pace moderate, we are still in a net liquidation of the beef cow inventory. Would expect with the January 31st inventory report getting released next week for around a 600,000 head decrease as far as our beef cow inventory goes. So we're still in this phase of the cycle where this blue line is decreasing. We just had our first decrease in the Fed harvest number here in 2023. We do expect those to continue, and we had the big lift in prices really over the last 3 years, but the suggestion that as the supply outlook continues to remain favorable, that we can still maintain these elevated price levels for a few more years to come. Just looking at where we are from a drought perspective, we did still face some challenges in 23. It was certainly a lot better than what we saw in 22, but especially here in some of our key cow-calf states, when we look at Texas, eastern Kansas, eastern Nebraska, Missouri, Iowa, and we check those in the top 10 as far as our beef cow inventory goes, you very quickly had a significant portion of the herd that was impacted by drought fairly severely at a key time for when we would have been making that heifer retention decision. And we really haven't seen any signs of heifer retention to date. Certainly regionally, there's some occurred, but especially where we have such a significant portion of the herd being impacted by drought there in the late fall, we just didn't see those heifers actually get pulled out of the fed supply and go back into the breeding herd. Now we are taking a step forward. We see some drought improvement, but the reason that we're cautious as far as a full switch towards expansion is really this chart right here. And this shows the probability of remaining in that El Nino phase that tends to be more favorable from a precipitation standpoint versus shifting back to La Nina that can lead to more regional droughts, whether that's in the South Plains, Central Plains, or North Plains. It's kind of yet to be determined, but our forecast would indicate that we are going to go through that transition where El Nino and we'll still have precipitation here in this spring time frame through February, March, and April, but we quickly transition towards neutral with La Nina coming back to be the more dominant factor by summer and into the fall time frame. We think about that again from a regional drought perspective. If we do see drought start to develop back, especially in this South or Central Plains region, that doesn't lend towards an expansionary type of environment. So maybe we still put heifers on feed in that regard, but it doesn't tell us that in the long run that we'll be shifting towards bigger supplies. If we look at what that means from a cow inventory standpoint, I already mentioned that we are expecting around a 600,000 head decline in the beef cow inventory there into 2024. We've been in this phase since 2019, but it's appearing to be a more drawn out and extended type of liquidation phase in comparison to what we came through in 2014 and 2015. I know the price break that we went through there in the fourth quarter is somewhat reminiscent of the kind of volatility that we saw when we rolled off the highs that occurred in 2014. But the supply situation does look dramatically different relative to that cycle, where we had this kind of abrupt impact where we took supplies much tighter into 14 and then rapidly expanded, partially due to profitability and because this was one of the strongest El Ninos that we've seen in the last 40 or 50 years. This isn't shaping up to be like that from where we are from a stabilization of the herd standpoint just yet, and the weather isn't quite nearly as friendly as we saw in that cycle either. So it would suggest that we will see some stabilization into 2025, and the earliest we start to see this herd start to increase closer to 26 or 2027. When we look at things from a beef heifer replacement number, this is also where we see a pretty key difference, where we still don't see an abundance of replacement heifers getting kept back into the breeding herd. So even though beef cow slaughter was substantially lower by around 430,000 head in 2023, we just didn't have enough heifers to go back into the herd yet to see that beef cow inventory numbers start to stabilize or even increase. That's another difference from where we were in this 14, 15 time period as well, because we'd already started to keep heifers back to a pretty meaningful degree into 2014. That's what takes your fed slaughter down so abruptly, but once they start producing calves, that comes back into our fed supply. So we're still in a stage here where we aren't seeing that, and if we think about the nearest term prospect, if we're still going to face some potential challenges with drought into 2024, maybe some potential for regional expansion just from a profitability standpoint, but not to a huge degree yet, even into 25. What that means back to the calf crop is that we should still expect tighter numbers as we go forward. We've been in a long-standing decline as far as our calf crop goes, and actually are approaching a level where the calf crop's about to be, in our expectations, smaller than it was in that 13-14 time frame. Now we do have a little bit of stabilization in 25. That's some of those 2023 born heifers that did get kept back, starting to contribute to the calf crop. But when we think about this from a fed slaughter perspective, Generally, from the time a calf's born to where it enters the slaughter mix is going to be 18 to 24 months down the line. So if we think about just our calf crop potential, 23 is one of the smallest we've had in the last 20 years. That takes us into late 24 into 2025, and then 2024 being smaller yet would then extend that into 2025, 2026. The other key thing that we're keeping an eye on, especially with the inventory report coming out for next Wednesday, is this outside supply of calves and feeder cattle, because we do have cattle on feed that's above year ago level by 1.5–2%, and I think that it's kind of surprising to see that, given that we are in such a tight window cyclically. But really, it was a product of having an extended period of a slower marketing pace, really through the second half of 2023, where we weren't being as aggressive in how quickly we were getting cattle harvested. We also had some drought force movement of cattle that put them back into the feed yard, obviously a lack of heifer retention as well, and then pretty big feeder cattle imports coming in from Mexico that elevated some placements in the fall and have that on feed above year ago level the last few months. The reason we think that we'll start to see that shift really comes down to this outside supply of cattle that we've already placed ahead of likely the supply that we have available. With these smaller calf crops kind of funneling into this number, the placement rate would suggest that as we enter the year, we're still 900,000 to 1 million head below year ago level from a placeable supply standpoint. So we'll be watching pretty closely for this report here on the 31st, and also the next cattle on feed report, to make sure that trend starts to show up, that we do start to see a pretty significant drop in placements from a year ago, as that's what will tell us that cattle on feed will start to drop as we get into February and March and lend towards tighter slaughter later in the year. We are still expecting around an 800,000 head decline here in 2024. With that, we had a huge drop there in 2023. We're still waiting on the final numbers, but close to 1 million head decline in fed slaughter. And that's the first time we've seen a big, genuine, robust drop outside of this COVID period. And note the difference where we're just starting this supply decline as far as a harvest rate standpoint here in 23, expecting to extend that into 24 and 25 as well, and some stabilization of the fed rate, slaughter rate down into 25 and 26. And much different than this V-bottom type of pattern that we saw in 14 into 15, where we pulled heifers out quite rapidly and then saw those calves hit the market just as rapidly as well. On the trade side, we have seen kind of a shift in 2023 where the trade balance has favored more imports relative to exports. We were relatively even for a number of years here in through the kind of 2015 forward period. We had record exports into 2022, both from a tonnage and value standpoint. But here in 23, where we've gone through the big adjustment in prices at the wholesale level, we've become a little bit less competitive on the domestic market, on the global market. In addition, some of our key export destinations, being China, South Korea, and Japan, facing some economic challenges and starting to develop, at least in regards to Japan and South Korea, perhaps a little bit more mature kind of market, just where the population is aging. They have a larger, older population relative to a younger demographic. And just as a country starts to reach those levels, they do tend to just consume less beef in general. Still big markets for us. They're still in our top 2. But we have noticed that those have been kind of our key drivers of our slowdowns from that record pace in exports in 22 into 2023. China's has been slower as well, and something that we need to keep a pretty close eye on as we go through the year. They're not without some pretty significant economic challenges as well from a growth standpoint, and some concerns there that they may be facing if their consumer population has grown a little bit more defensive relative to their spending. And if they're going to be a little bit more conservative in terms of their demand, maybe we won't be shifting out as much tonnage over to China this year. But we are expecting for more of a stabilization here for 24, 25, and 26. We think the big shift in exports has occurred, and we'll see more modest declines as we move forward. At the same time, it's very normal during this part of the cycle when our inventory levels get tight and our prices get to the levels that they've achieved, especially on the lean trimming standpoint. We do tend to import more. You see the same type of pattern take place when we were starting to stabilize the cow herd and reduce our cow herd liquidation through this time frame. So as we do approach that and start to harvest fewer and fewer beef cows, that's one of our key sources of our 90s lean trimming that Matt will talk about a little bit more, that we will bring in more of that product. It does tend to come in from Australia and New Zealand in particular. They've started to see that tonnage shift, and they're just in a spot where their inventory levels will support that. So we do expect bigger imports against smaller exports as we go into this next couple years. With that, just from a per capita net beef supply standpoint, this would take our domestic production, subtracts out our exports, adds back in our imports, and then divides by the population to get to this round per capita number. And again, 23 was the first year that we've had a decrease through the last several years. We had record production for 4 years straight from 19, 20, 21, and 22. Not record on a per capita basis, but just record production on a tonnage basis. And that's really what's driving this shift. That as we start to produce less, we are going to see these per capita supplies drop, even though we're going to export less and import more. So we'll start to see these declines take shape. We did in 23, still expecting that into 2024, and taking them even lower than we were during the last cycle on a per capita basis into 25 and 26. So from a supply standpoint, really we're still in a very favorable spot as far as prices go. But moving into the demand front, we're not without some headwinds there, especially here into 2024. I'll say that demand absolutely did exceed expectations for 2023, where we actually ended up with the third highest retail demand and the second highest wholesale demand in 2023, despite the highest interest rates we've seen in the last several years. Inflation certainly eating away at consumer incomes there through a period, but definitely positive some things going on as far as interest rates starting to stabilize. The Fed has signaled that they're likely done raising rates here in the near term, and are considering 3 rate cuts here in 2024. The earliest they've signaled would be that May timeframe, assuming inflation continues to stay more moderate between that 3 and 4% level. Their target is still 2%. We aren't quite sure they're going to achieve that, or that that's going to be achievable here in 24. Something that we need to keep an eye on. But the other factors, just from a demand headwind standpoint, these interest rates are still going to impact consumer debt as well. Consumers are already starting to carry larger credit card balances. You have student loans that have become due and are starting to see some payment on those as well. And that we just have the consumer at a point where they're maybe a little more pinched as far as their dollars go. On the bright side of the equation, the labor market remains very, very robust, very, very strong, where we do have unemployment near historic lows as far as people being able to find a job and keep a job and earn an income. When we do look at the income front, we've seen some destruction relative to the inflation into 2022. Started to see those grow through the second half of the years. We've seen inflation come down, but we're still below that longer run trend. So ideally, we will see some wage growth in 2024. That is supportive to beef demand, but we aren't necessarily expecting demand growth, just where the consumer is positioned from on an economic headwind standpoint. We started to see a little bit of pushback as far as prices at the retail side go. We had a big year as far as establishing new record prices with this all fresh retail beef price, especially this move started to occur really in that April, May, June timeframe. That's kind of when wholesale prices really got their big lift. June wholesale peaked in June at $3.40 as far as the cutout goes, and we saw the retailer respond to that higher cost in order to purchase beef by raising the retail price to new all-time records as well. We peaked at $7.94 there in October, and we've had 2 consecutive months, 2 consecutive months where prices have slipped a little bit. So we are starting to see these likely flatten out. And I think it kind of takes shape similar to what we came through into 21 into 2022, where we saw the adjustment in retail with this red line, took prices to that 750 level, and then saw an adjustment throughout 2022 where we spent the bulk of the time around that 730 to 720. So it's kind of a similar type of price action where retail pushed up to 780. Do we have to come back to 775 or 780? Is that going to be kind of the level that supports us? The reason that's important for our outlook is that helps us establish what should our expectation be as far as a Fed cattle price based off if this is where the retail market is going to be, what's that average leverage, that average relationship between the Fed price minus the drop in relation to that all fresh beef price. And we've gone through a big adjustment, in particular into 2022, where this got as high as 23% of the all fresh price. Would expect something to be a little more moderate here this year, so kind of between that 20% and 22% level. With a $13 drop, that kind of implies that our Fed market should spend the bulk of its time between this 168 and 187 level near the highs. Now, that's assuming we do maintain this retail price. If we do see an economy that takes on a more defensive front, we see more pushback at the retail level, this same leverage obviously wouldn't support a Fed market that's at these levels. So that's something that we need to keep an eye on to figure out where do we settle in and find support. We still think that this is about the right level, but something that we want to keep an eye on. We are expecting slower beef demand as we look ahead into 2024 and 2025 and 26, but the supply side of the market is still very favorable. And when we plug in these prices relative to the supply, we can still have higher prices at the wholesale level, even with a shrinking demand environment. Now, demand has been pretty exceptional for a couple of years out in here, especially in 2021 with the restaurant reopening, and definitely surprisingly good in 2023. Now, we are expecting it to be softer, but we're still seeing pretty historic demand levels relative to how far we've come, especially relative to the global financial crisis and when we had to buy back demand after the peak in the last cycle. So still strong demand historically, but not necessarily a phase of the economy where we should expect robust demand growth. The other thing that's favorable just from a cattle price standpoint is the shift we've already gone through from a leverage standpoint. Really what's driven that is the rebalance of the amount of cattle that we're going to be harvesting on a weekly basis relative to our underlying harvest capacity. That as we came through the decade, we were actually losing capacities. There wasn't a lot of profitability for a lot of these plants, and we closed several of them into that 2013, 2014, 2015 period. When we expanded, we overshot just from a supply standpoint relative to the hooks we've had, and we've been in that phase relatively for the last since 2016 into 2022. 23 was the first year where our weekly average harvest rate there around 500,000 head was right in line with what we have from a capacity standpoint. So we're no longer having to harvest on Saturdays, and obviously this was certainly extended with the slaughter disruptions and the inefficiencies during that COVID period as well, that we ended up carrying around 1 million cattle from the Holcomb plant fire, the COVID disruption, that we really didn't work all the way through until we got into the fall of 2022. When we finally started to regain currentness as far as our fed cattle supply goes, we did see these big adjustments, in particular from leverage. So this takes that Fed price similar to what we looked at on the retail side, but just looks at it relative to wholesale. And we see the same type of trend that when we started to overshoot the supply level relative to our capacity, in 2016 was the first year we saw a big drop in leverage that was exacerbated into 2020 and 2021. So as we've run back up the ladder, we've seen huge leverage shifts. That's part of the big lift that we've seen in cattle prices here in part of 2022 and 2023. But the thing we need to be aware of is these big lifts have already been priced into the system, and we're going to be a little more moderate as far as our leverage gains here going forward. So we've seen the big shifts as far as prices go, likely in this cycle. Doesn't mean we can't still maintain this ground and still be higher, but not going to be the same kind of year-over-year increases, at least from a suggestion on a leverage standpoint. Now, we have put together and looked at the last several cattle cycles, and I think it's useful to look how they kind of took shape on a real basis, not just like that chart that we started the conversation with, because we can get a little better feel of how do prices respond as we go through this liquidation phase in the herd. We look back at the 70s into the early 80s, the 80s into the 90s, and the 90s into the early 2000s, mid 2000s. We do see a few similarities between those three cycles that are different than the cycle that we saw in 14, 15, and maybe more akin to the cycle we're in right now, where it was a more extended liquidation phase of the cow herd over 5, 6, 7 years where we stabilized it. and prices ended up pushing higher and then maintaining higher levels for longer as well. We see that in that cycle, see it here, and see it there. Instead, as opposed to how rapidly prices readjusted in that 14-15 time frame into 2016. The other thing that we notice is the price high tends to occur in either the same year or the year after the low in the cow herd, where in 3 of these 4 cycles, it's the same year, or where the cow herd low occurs is where the high occurs, or it's the year after. So if our bias is still that we're in this liquidation phase and still facing those headwinds, does still suggest that the highest prices could still be in front of us as far as this cycle goes. The other thing we notice is your supply low tends to occur after the price high. So the market will price in the highest price ahead of actually making it to the tightest supply. So that's something to be aware of from a defensive standpoint, from a risk management standpoint. If you're exploring options there, or maybe thinking about using LRP, that the things are good now, things are profitable now, but what about when the market does eventually shift towards a growing supply environment? How soon do we need to be able to respond to that? That prices do tend to start to move lower ahead of that moment. So something that just from a big picture standpoint, worth taking into consideration when we think about just this cycle in particular. We can see that from this COVID low in 2020, we've had 3 years of big adjustment in prices. Part of that's tighter supplies, a big part of it's leverage, right, that we showed on a couple charts back. Now as we go forward, that big adjustment has occurred, especially from a leverage standpoint. We're facing a favorable supply environment, maybe some demand headwinds. So not as much lift as far as fed cattle prices go as moving forward, but still strong into 25 and 26, with the lows in the cow herd likely still ahead of us and that supply low still ahead of us. Well, maybe it's not 26 is the high, maybe it is 25. I wish I could perfect that for you and tell you all when it's going to be. But I think the general trend is something we need to be aware of and take as valid given our supply outlook and the demand outlook. With that, I'll pass it over to Matt McQuaig, and he'll do a little more discussion on the feeder cattle side, calf side, and the female market.
Thank you, Terrell. So as we move into this market outlook section, we want to start with the feeder cattle index for 800-pound steers. So the seasonal pattern starts off the year with flatter prices early on in the year. This is due to a large supply of fall weaned calves coming off of winter grazing. Then as we move into the early spring and into the summer, prices increase as that supply becomes limited. This year, we started the year with that historically low supply of outside cattle that Terrell described earlier. But to counter that, we are starting also with an ample quantity of cattle on feed due to large placements in late 2023. But as we move throughout this year, the tightening inventories can help drive up prices earlier than usual. And we're kind of expecting to see that climb starting in April instead of a little bit closer to May and June. That being said, we're looking at prices to be around $10 to $20 higher than they were in 2023. And this will be particularly true if we get some late winter moisture that helps dry out that feeding period. We have to remember that cattle placed in May and June are going against the December live cattle contract, which already serves as a premium. And with that being said, we foresee limited downside risk, again, with the lowest prices earlier in the first quarter with support near that 220 mark, and then advancement towards 260 or better in the second half of the year. Looking at our weaned calf prices for 550-pound steers, I want to start with 2023, and you'll notice that line doesn't follow the seasonal pattern. That's because we kind of started with a rough winter in the north. A lot of that graze out was covered in snow, and then in the south we were dealing with drought issues. And so that kind of delayed that upward move, but ultimately the tighter supplies that kept prices moving higher later in the year to increase around $70 per hundredweight on average from the 2022 levels. And so those were extremely large changes. This year, we don't expect to see quite that significant of a move. Tighter supplies will drive the market higher, and that's coupled with cheaper feed and better grazing expected through this year. And so we expect prices to peak in early spring at around that 315 to 320 mark, 330 mark, and then follow that through a modest decline into the fall run with a yearly average of $290 for the year. This is about $30 higher than what we saw in 2023. And again, not quite the large correction or move we saw in 2023 of $70. So as we look at these steer calf prices, one ratio we like to look at is the percentage change from the second half low of the previous year into the first half high of the current year. And so you'll see there that the 20-year average is around 24%, 25% is a common mark. And with last year's low prices, this implies a first half high in 2024 of $336 to $340. We think that's probably a little optimistic. Again, we expect it to be around like a more of a 15 to 20% change. Again, that's the 315 to 330 mark for the high for the first half of the year. And that kind of follows with what you'll see here. As you see some of these price years, like that 13 to 14 ratio, that 16 to 17, they both had very large moves, and then they were followed by significantly smaller moves around that 15% mark. Again, we kind of expect to see that pattern follow for the first half of this year. Moving on to our utility cull cow prices. We all remember cull cows display a very strong seasonal pattern. They're the strongest moving into that spring and summer as there are fewer cows being brought to the market. This is coupled with summer grilling activity heating up, which helps drive strong ground beef demand. As we look at this, we have to remember that our cull cow prices provide, or our cull cows provide a lot of that 90% lean ground beef values. And so again, we'll see that kind of pick up in other charts. But again, as we're looking into this year, we expect to see those summer highs peak at around $115 to $125 range. And again, that's around $15 and higher than what we saw last year. So again, we expect this to kind of follow a seasonal strong pattern. And then that Labor Day typically marks the point to where prices start to decrease. And so this provides a great opportunity for producers if they have any, say, older females that they know they will not be retaining. If you can serve or you can wean these calves early and cull those females early, there's typically very significant profits to be made as opposed to waiting until October, November, and December. So again, this is that correlation I was talking about. 90s prices are well supported with those cull cow values. And so you can kind of see that here as they move upward, moving into the summer. Again, as they exhibit this seasonally strong pattern, we anticipate a higher moving market. Again, tying in that spring grilling demand. And these higher prices are further supported back to those cull cow values that we were just talking about, as again, they serve as that support source for the 90% lean production. So moving from cull females to bred females, this relationship between bred females and steer calf prices exhibits a very strong correlation over time. You can see that over the past 40 years, those two values have tracked very closely. The past 10 years, there has become a bit of a gap or range widening between the two values. This is due to interest rates stabilizing at lower levels. Terrell talked a little bit about some of those economic effects and how we expect to see, as we relate those higher interest rates and inflation rates back to this, that is causing that gap to narrow a little bit in this past year and looking ahead into the next year. And this is particularly true as it relates to the bred cow prices. We have to remember that bred cows are fixed assets in the herd, and so those interest rates help play a large role in that relationship between those ranges. Looking at this, we are seeing large growth in both values or both ranges, and we have to. But as we look at this, I want to point out that as calves are increasing, cows have not quite kept pace. this past year in 2023, we saw record prices for all classes of beef and cattle, except for replacement females. So our composite beef cutout, our fed steers, our weaned calves, all of those values saw records in 2023, but we did not quite match that peak with our bred female values. And so what that tells us is that even despite these relatively large price increases, bred females or replacement females are still relatively inexpensive compared to with where we expect them to go. And a lot of that is just due to these structural expansion headwinds that we've been facing of drought, interest rates, labor challenges, our increasing producer ages. And so as we look ahead to the coming years, we expect some of this correction to occur. And so we created this calculator at the end of 2023. And basically what this does is it ties in the carry costs for females. It couples that with their initial purchase price, that carry cost, and then the expected calf values moving forward. And so what this does is it tells us that over time, replacement heifers have to have 4.5, 5 calves to pay for themselves. And so as we look at this, this is a calculator and equation that you can do on your own operations using your own carry costs. If your carry costs are a little bit higher than this, then obviously you'll have to add a few more calves. And as I point this out, I want to emphasize that this is done on a cash basis, meaning it ignores those non-cash costs of interest and depreciation and unpaid labor and management. But on the flip side, it also does not include salvage value to kind of help counter that a little bit. And so as you can look at this chart over here, in 2023, it took 2.3 calves to pay for a female. And so again, with these high values, or despite these high values, these females are still relatively inexpensive. Terrell talked a little bit about the very sharp or rapid change that we saw in 2013, 2014 in that last cycle. And it resulted in some of those 2015 females penciling out at having to produce 9 calves to pay for themselves. And so many producers wound up with females that they were upside down on and they never paid themselves off. The little bit slower expansion rate that's expected for this year is actually favorable for these replacement female values. And it should result in the next couple of years, you look at that 3.0 for this year and 3.5 calves for next year. We foresee that as still being, as those females still being relatively good buys compared to where they can go. And so this table kind of shows some of that. The challenge with this, or the skill that's required to evaluate this, is having to anticipate where calf values are, not just today, but in the next 4, 5, 6 years. And so as we've said, we expect prices to kind of be around that 300 mark average for the next few years. But as we want to say, just pick one of these line items, we'll look at the current values that are expected for 2024, and that's at around 550 pound steer price of 290. And as we look at that, that shows us that females or bred females that we also forecasted to be at around that $2,600 mark before they pay for themselves. This chart matches that perfectly. Bred heifer has to match or has to produce 4.6 calves to pay for herself. And so as we then use this to look forward at that $300 average, it's not unreasonable to expect calves to reach, or to expect replacement females to cost $2,500, $3,000, or even further in the foreseeable future. And so again, this will be even further driven by expansion patterns once they take off. And so again, this is just something to think about on your own operations. I know, or I fully admit and recognize that $2,600 for a commercial replacement female seems outrageous, but relative to where we expect the calves to go, it's not unreasonable to have to deal with that and expect it to go even higher. So as we look back and we compare some of these different classes of cattle and price trends, if you look back at the previous year, we saw a very rapid adjustment or market correction and moves. And we expect that the trend to continue, but those moves should be a little bit softer moving into the next few years. These supply declines are what are driving this change within the cycle. And then once heifer retention starts to occur within 25, 26, we'll see that start to level off a little bit, or at least slow down the rate of increase. And so this ultimately, or as we look at this, that relatively tighter supply relative to the packing capacity, and then those increases in packing capacity that Terrell talked about, will help shift that leverage and should lead to steady to higher beef prices, and then also allow cattle prices to catch up a little bit to those rising beef prices. And as we consider that, we ultimately have to remember that consumer demand will be the key to how high the market can trade. So as we wrap up the discussion, it's always nice to kind of look back at industry profitability throughout the years. This chart is margins on a per head basis across all sectors. And so looking back in the 80s and 90s, we as the beef industry were not heavily focused on consumer preferences or eating quality, and it hurt us. It resulted in average profits of around $30 per head. In the late 90s and early 2000s, we made a significant shift to improve that. That resulted in increased demand growth and led to higher average margins or profits per head. And then the last 10 years, profits have averaged around $500 per head. They shot really high in 2023, and we'll slow down a little bit in 2024. But as we look ahead, this shifting leverage will improve, particularly for the cow-calf producer and stocker operator. This is again due to that excess feeding and packing capacity that's forced to chase a tightening feeder cattle supply. And at the end of the day, more dollars per head in the system is what the industry needs to kind of help itself become more sustainable over time. And so, again, this is a good thing, and we're in a good situation moving forward. With that, I'll turn it back over to Terrell to wrap us up.
So do want to just say thanks again for everybody that joined us here tonight. Just did want to put a few things on your guys' radar that one helps us out as far as our cow-calf survey goes. You can go to CattleFax.com, and under the About tab, we do have that 2023 cow-calf survey available. So that's for production year 2023. That really provides a lot of great data for us and perspective around the industry as far as what practices are the most profitable for producers, where are our costs at, and we really appreciate those that take the time to fill that out. I think there's also a prize associated with it that's a drawing if you do have the time to do that, so maybe take a look at that. We also will be given Global Protein and Grain Outlook and U.S. Outlook in Orlando next week on February 2nd. So if you're down at convention, please think about joining us for that. If you can't make that or are going to be down there, please come by the booth and introduce yourselves. We always really enjoy getting time to meet producers and get some one-on-one time to discuss the markets or whatever else is on your guys' mind. And then next time we'll have the next Trends Plus webinar there on May 22nd. Still be same time, 5:30 Mountain Time, be a Wednesday night here in the next few months, and that's where we'll present the results of the 2023 cow-calf survey. So if you want to tune in and see what that's all about, that's the date for our next webinar. But that's what we have for you guys here this evening. If there are any other questions that you think of after we get wrapped up, feel free to email either one of us. This webinar is recorded, and we'll go out to all the registrants here at in the next couple days. We'll also post it on our website. So if you want to watch it again or missed it, it'll be available to you there. But thank you all, and have a great rest of your day.